Or, no. Okay.
They're done. They left. With the lights?
With the computer.
Hey, Jonathan.
Hey, how's it going?
Good. How's life?
Life is great.
A lot of talking about things, and and I try to help her see her mom's point of view, and I try to have her mom see her point of view, because they really do a lot of sandpaper paper stuff,
Yeah. Hey, I have a conference call I have to jump on, so can I
Okay.
call you back?
Okay, I'm recording this one today because I'm going to ask, we're going to have two things we're going to go over, and I think it's important to share with everybody. Hi, Sabina.
Good morning, everybody.
Hi, Mike.
Morning.
Okay, there's Gabby. So the two things I want to go over today is the latest of market updates, which we discussed, Mike. So I want to go over that, if you could share. And then the second thing is that everybody's talking about the new conforming loan limits for Fannie and Freddie. So if you guys could talk about that with us as well. And then if anything else anybody wants to talk about, we'll talk about after those two things. Deal?
Let's do it.
Let's do it. All right. Market reports. That's the most exciting, right?
You want to talk about that first? Okay.
Yeah.
Well, first of all, welcome everybody. Good to see all your faces. Hi, Gabby and Jonathan and
Yanni's hiding back there.
Yanni, and I know you're back there somewhere. And hey, Kyle, I talk to you all the time though. Yeah, let's talk about market. The name of the game is Omicron. Does everybody know what that is?
Yes, a nasty virus.
Yeah. So
Cool name.
Omicron. I think it is. So, just to sort of step back for a second, the stock market, for anybody that follows any of the markets at all, the stock market hates instability, right? And so, as you all may know by now, the stock market has seen some significant losses here the last few days from when the Omicron news broke this weekend. And so it sent the stock markets into a bit of a tailspin. So you're seeing some incredible volatility in the stock market, primarily losses, although it's been volatile. And why I bring that up first is because typically it's an inverse sort of relationship between the bond market and the stock market, meaning when people flee the stock market or leave temporarily because of the instability, very often they move their money to the bond market. So bonds, which I'll get to how this correlates to rates here in a second, but so instability in most cases is bond friendly, right? Because that money is now moving to the bond market. So what that means is typically, the interest rates are in many ways change based on what the bond market does, specifically the 10-year note. And so we have seen some slight rate improvements due to the instability from Omicron. Okay. And I say slight improvement because the same volatility exists in the bond market as it does in the stock market, because, as people are going in and out of those markets, it's having these sharp moves. So for instance, what's today, Thursday? On Tuesday, I sent out an email to my team and said, hey guys, the bond market's rallying, we're up, rates are improving. And 30 minutes after I hit send, we were going the other way. and I was, forced to send out another email to change tune. So the moral of the story here is two things. One is, look, I think that rates in general are going to be fairly low for longer, meaning we're going to have these ebbs and flows in the market, and there's probably going to be anywhere from an eighth to 3/8 in rate movement day to day or week to week. So timing on some of these locks can be important from that regard. But I don't see any huge moves one way or another outside of that eighth to 3/8 in rate for a while. And I really think that we can know that there's, big picture, some fairly good consistency there. I've instructed my team, Ruben and Kyle are both on this call, and obviously the rest of the folks that aren't. But I've instructed my team to just be locking, right? Like, we're not in this environment where we want to float rates unless there's some good reason to do it. So, for instance, if it's a new construction deal and we just have no idea when it's going to be built and when we're closing, you can't lock, right? Because there's just no known timeline. But when we get a contract in and we have a known timeline and we know when the closing date is, we're locking on application unless the borrower tells us not to for some really great reason. So look, that's just the best way that we can go about protecting the clients and making sure that we're doing what's in their best interest. But we are really on top of what's happening, and I send out updates to the team daily, if not more so, depending on the market movement. So we know when to lock and when not to. But it's certainly something where we're not taking chances due to the volatility right now. But big picture, short term, excuse me. Listen, 30-year fixed rates are in the low threes, and that's where they are right now.
Oh, I'll ask Courtney. Need the phone. We're in a meeting.
We're in our Q&A.
30-year fixed rates are still in the low threes. Like I said, they're going to ebb and flow based on market conditions and credit score and down payment and all these variables. And 15-year fixed rates are still in the mid twos. So rates historically are still really great, guys.
Nice.
And I think we're in a good place right now, at least from that perspective.
Love it.
What
Thank you.
questions do you have? That was a bit technical, I know, but any questions I can answer about that?
I think you did a good job of explaining it. I got it. So we're good. I'm just kidding.
Okay.
No, but
Great.
I'm sure somebody has a question. John? No?
Nope.
No. Yeah, I told you did a really good job of explaining it.
Yeah, you did.
All right. Beautiful.
Does anybody have a question? And I would just like to throw in there, welcome back, Ruben.
Yeah, there he is.
Praying
The
for
legend.
you
He's
and-
alive.
Yeah,
He's
thank
like
you.
Evans.
Glad to be out of the hospital.
I bet. It's a little too long for I can't stay still for that long.
For those of you that don't know, Ruben was unexpectedly rushed to the hospital and was there for 3 weeks.
Yeah.
It was a bit tenuous at times, but he's recovering, and things are certainly he's back to work here, and things are going the right way. So it was.
He only took one day that Mike went to see me, and the next day they gave me, discharge. I wish that he would have gone the first day I was at the hospital.
Right?
Yeah, funny story. So he was in the hospital for 3 weeks. So I went to see him on whatever it was, day 22 or something, and we sat there and talked for a while. And I made sure he was doing okay. And literally 3 hours later, they discharged him. So he's like, "Dude, why didn't you come visit me like 2 weeks ago?"
That's awesome. You brightened up his, I don't know, made him healthy. I don't know. Okay, so next, who wants to tell us more about the conforming loan limits, Fannie, Freddie? I know it was mentioned once before, but now everybody's talking about it again out there in the world. So let's talk about it.
Yeah,
Explain it. Tell us about
any
it.
of us could do that, but I'm been talking, so I guess I'll continue to talk. You guys are all used to that. So yeah, Fannie and Freddie just announced, officially announced what the numbers are. So the conforming loan limit previously, just in case anyone doesn't know, was at $548,250. Okay. So what that means is, as long as a borrower kept their loan at that number or less, they were in what's called a conventional or a conforming loan limit, and you always get better loan terms in that way. Okay.
Mhm.
Anything above that 548, 250 was considered a jumbo loan. Okay. So we have had the highest jump, I think, in history from 2021 to 2022, which was just announced yesterday. And so the conforming loan limit has gone from 548, 250 to 647, 200.
It's a big difference.
So almost $100,000. And that speaks directly to the average home price sales over the last year. Home price sales have skyrocketed. Being in South Florida, we all know that, right? Like you guys are at the epicenter of that. So it's speaking to the market and what's happening, and the appreciation, the incredible appreciation that we've seen over that time. So conforming loan limits have gone to 648, 200, 647, 200, excuse me. And the FHA loan limits are always at 65% of conforming loan limits. So the lowest FHA loan, and this is based on county, as you know, so it's higher in some of your counties down there, which I actually have that data too. But the lowest loan limit for an FHA loan right now is I just had that on my screen here and I lost it. 420. I think it's 426.80 or something. Let me see.
Well, I'm sorry, I didn't hear. What was the question?
No, the answer.
I mean,
we're
what was the question?
Well, we're talking about conforming loan limits, and Fannie and Freddie have changed their limits. And so he's telling us about the different limits now. They're for conventional and FHA. And you said FHA, the lowest is 426.80.
Yeah. So conventional is 647, 200.
Right.
And I'll tell you, in Palm Beach County, because they're obviously one of the high, you guys do a lot of business there.
Yeah.
The FHA loan amount it has now gone to 460. Palm Beach County, and it was prior to that, I believe it was 402.
Okay.
So again, a
Up to
huge jump there.
460. Up to 460, right?
Correct. So the FHA loan limit in Palm Beach County, and this is, again, it varies by county, but I just chose Palm Beach because it's where a lot of the business comes from. Is 460,000.
Nice.
And I can, what I can do is actually send everybody a link to search by county if that's helpful.
Sure.
Yeah.
Awesome.
Yeah, so significant increases in the loan amounts for both conventional and conforming, which is they're synonymous, and then for FHA loans as well.
Yeah, like $100,000 both.
Significant.
Yeah.
Yeah.
Awesome. Okay. Now I know Shelley jumped on today because she had some questions that she wanted to ask and about some current. She's newer and she has a current situation with an FHA loan. As a matter of fact.
Fire away, Shelley. What you got?
So obviously cash is going to be the first offer that people take. And then, it appears that FHA loans have a very negative sort of vibe about them. And so I've said to my client who's maybe it would be a good idea to offer a little something extra to get you in the running. And in that conversation, I just wondered why somebody would have so I asked him, why don't you have a conventional loan? Because I thought conventional loans you could do with a 5% down. Is that the case?
Okay.
Okay, so then why would someone, I know FHA is only 3.5% down, but why would, if somebody can put down a 5% versus 3.5%, then why would they choose to then have an FHA loan? Or perhaps he's just not knowledgeable and I need to tell him that you can get a conventional loan at 5% down.
Yeah.
He's gonna tell you why. Go.
Fantastic question, Shelley, and thank you
Thank
for
you
asking it.
very much.
And I get this a lot. So the short answer is they could, and I don't know the details of this borrower, but the short answer is they could probably get a conventional loan. Conventional loans allow for as low as a 620 credit score.
620?
Correct.
Yeah, okay.
And however, conventional rates.
Somebody mute. Who is that? Sherry, mute. Oh wait, I'll mute her. Okay, sorry.
Yeah, conventional loans, rates, and particularly mortgage insurance premiums are score driven.
Yeah.
Okay.
Yeah.
So what I mean by that is, if you're doing a conventional loan and your credit score is below 680, there is a significant difference in most cases on the cost for your mortgage insurance and your interest rate as it relates to an FHA loan. So in most cases, you can get a better interest rate and much lower mortgage insurance, giving you a much lower payment on the FHA loan versus the conventional.
Okay.
The other thing to know is that FHA allows you to go much higher on debt to income ratio,
Yeah.
Shelley, than conventional does. So like I'm making up these numbers, but they might qualify for a 350 conventional, but they might qualify for a 425 FHA
Right.
sales price. So especially with an increasing sales price environment that we're in, it's almost always likely the one or the combination of lower scores or higher debt to income ratios.
Okay. Yeah.
So I'll give you an example. I was just talking to a client. Now this is 2 weeks ago now, but I was talking to a client and they had like a 635 score or something. So they qualified, but they were in this like mid 300 price range. The difference in payment when you factored in the score and the mortgage insurance between a conventional and an FHA loan was like $250 a month.
Wow.
I mean,
with the FHA loan.
Yeah, it was $250 lower
Yeah.
with the FHA
Got it.
due to mortgage insurance and rates than if they did a conventional. So it can be significant.
Yeah, got it now. I get the
which is
difference. Yeah.
likely what's happening. Now,
Okay.
two things I can suggest here, Shelley. Again, I can just speak to what we do. I don't know if they've talked to somebody else and what they do, right? But on our side, if it's a client that we're working with or you want to introduce us to, two things. One is we always look at their credit scores and we always look at potential solutions to raise those scores.
Yeah.
Okay, so we have the ability to run like an analytics thing, and it tells us, hey, if you pay your credit card down $100, your score will go up 7 points, this and that, right? So a lot of times we'll talk to that borrower and say, hey, you've got a 672 score. If you pay your credit card $280, you can get a 680 score. Let us help you with that, and that could change you from an FHA to a conventional.
Yeah.
Right.
Yeah.
Option two is if it is an FHA loan, we have what's called a fully underwritten pre-approval loan product. Okay. So what that means is we can take that FHA borrower in this example, and we can, we'll collect all the documents. We'll collect income and assets and credit and, all these things, right? And whoever's working on the deal, Kyle or Ruben or Haley, whoever, we will take that loan and we'll submit the loan to underwriting before you give us a purchase contract. And we'll send the loan to underwriting, have the underwriter underwrite the loan,
Yeah.
and they will approve credit, income, and assets, right? The three main reasons why loans get denied. And we will issue you a fully underwritten pre-approval letter. So you asked, hey, what's a differentiator? What's something that you can do differently with an FHA buyer? What I would suggest is if you have something like that and you want to stand out, talk to Ruben, talk to Kyle,
Is that called a DU? Is that what you're talking about, a DU?
Well, we always run DU. We take it a step further. We're going to have a live physical underwriter underwrite that loan as if you had like an accepted contract already.
Okay.
Normally we don't do that until you have an accepted contract. We're going to do it before you even, if you want, before you even show property to this buyer or even potentially start, to negotiate a contract.
Mm-hmm.
The benefits of this is it's almost as good as a cash deal because you can present this letter to the listing agent and say, hey, listen, I know I've got an FHA buyer, but guess what? This is an underwritten loan. We've already approved income, assets, and their credit. So there's no reason that they would be denied unless they lost their job or it didn't appraise or the title work came back flawed or just something funky that's really kind of unforeseen. But you really overcome any potential financing issues because you already have an underwritten loan.
Yeah. Brilliant.
If you're a listing agent.
Yeah.
So that would be something that I would suggest, and that is a huge differentiator, and you could absolutely stand out in that way.
Yeah.
It takes us an extra day or two to underwrite it, but that's not big.
Okay. I know that he's already with Cross Country Mortgage, but
you should switch them, Shelley.
okay. I can do that.
I know you could do that.
Yeah, I can do that. Yeah. I don't know if I can do that today, but I mean, all right. That's my goal for today.
Right. You can,
okay.
Doesn't hurt.
Yeah, I can try. Yeah.
You can tell them that all they have to do is have a conversation with them and they can decide.
Yeah, just
and it doesn't hurt to talk to a couple of different lenders to try to find what's the best rate, the best everything for that buyer.
Yeah.
Yeah, like let us have that conversation. Don't feel compelled or stressed, Shelley, around you having to quote unquote sell another lender. Just say, look, I had a conversation with a lender that I work with, a lot, and they have some pretty unique things to make your offer better, maybe even get you better loan terms. It's worth a phone call and set up a phone call. Let us handle the rest, right? We can sell the value of that and talk them through the process, right? That's our job. But your job, at least as I see it, is just making the introduction.
Yeah.
Getting them open to another conversation.
Thank you so much. That was a lot of good information.
You're welcome.
Always.
Gabby, anything on your end, young lady?
No.
All right. Anybody else have any questions or thoughts?
Going once. Oh, one more thing. Why don't you tell everybody you have a training this Friday, right? Do you want to just talk
the words out of my mouth? That was our next topic here. So,
all right, we're on the same page.
Courtney and we are really aligned here. So we did some training in the past. For those of you that were there, Kyle and I were there, and we did a little fun bowling night, and we did some training the following day, and it was virtual, and we were also there in person. Which, by the way, we're going to be there in January as well. I'll get the dates out to you guys soon.
Yes.
I'm going to do some similar training again tomorrow, designed for some new folks that have joined the team and didn't have the opportunity to be in that. And it's going to cover really a lot of what we talked, more expansive on what we talked about today with Shelley, which is one, how to introduce the lender, right? Like what to say, how to overcome an objection, things like that. But two, it's going to be a real high level overview on loan products, why they're different, what the score differences are, rates, loan amounts,
Rehab, you guys should talk about the rehab loans too. Those are cool.
We can. Yeah, we can.
I
We can
would.
talk about rehab loans. Yeah. So it'll just be a nice high level overview. Again, listen, we could make this training weeks long, right? But this is kind of a high level. And then we just kind of open it up for questions, from the group, and we can get as detailed as you want. But, we just want to be able to arm you with as much information as you can have to just feel confident that you can speak educatedly to your clients if they do happen to ask you a financing question. And if you want to be able to answer them. Sorry, got distracted here. Yeah. So anyway, so that's tomorrow at
11, I think.
11.
Is that right?
11 o'clock. Yeah.
Yeah, perfect.
It's slated for an hour and a half. Feel free to anybody that wants a refresher that did it last time, certainly jump on. And anyone new, we are hoping to have all of you on the call.
Awesome. I'll make sure all the new agents are on that for sure.
Yeah, great.
Get a chance to get to know you a little bit better.
Oh, we love getting to know people.
I know.
Know that. Awesome. Well, listen, we always love being on these calls and seeing all your faces. So unless anyone has any more questions, we will reconvene tomorrow at the same time for those that want to be on the call.
Sounds perfect. Thank you so much.
Thank you, Mike.
And thank
You're
you for
welcome.
everybody that participated. I appreciate it.
Talk soon, everybody.
All right. Bye.
Bye.